talk about what is money. That is a $1 million question. How much is enough? So the benchmark should be around 250, 300 crores.
Well, I wouldn't say that's a benchmark where, probably
in
that's
order to get
fucking
the
money.
fuck you money.
Absolutely.
Bro, the real reason people invest is so they can flex on WhatsApp groups.
Hard hat.
Welcome to Face2FACE, Conversations That Matter, a podcast brought to you by Face Media Network and hosted by yours truly, King Porwal. Face2FACE is where real conversations meet real insight. This podcast brings together entrepreneurs, industry experts, and thought leaders who share their insights, their lessons, and perspectives on business, finance, culture, and life. Through interactive conversations and honest storytelling, this podcast wants to inspire people to think bigger, act smarter, and explore opportunities in this ever-evolving world. This podcast is brought to you by Brick and Beyond, a corporate social responsibility initiative by Downtown. Downtown is a real estate development firm based in Mumbai and is focused on creating a redevelopment platform recognized for its transparent governance, thoughtful design, and impeccable craftsmanship. Through Brick and Beyond, Downtown is committed to spread financial awareness and empower the next generation of real estate investors.
Today's guest is someone who knows how to build with numbers, just like we build with bricks. He's not just a wealth manager, he's a financial architect who crafts strategies as thoroughly as we plan blueprints. Joining us today is George, director at Anand Rathi Wealth, one of India's most trusted and forward-thinking financial advisory firms. With nearly 2 decades in the business, George has seen market cycles come and go. But what hasn't changed is his ability to bring clarity, calm, and conviction to the world of wealth. From decoding risk to designing legacies, George brings a unique perspective that makes finance feel more like a lifestyle and less like a lecture. If you've ever wondered how the ultra-rich actually think about money, this episode is your backstage pass. George, welcome to the show. We both know success means different things to different people.
Absolutely.
Right? For some people, it might be money. Some people, it might be power. किसी को घर चाहिए, किसी को जोरू चाहिए. Different for different people. But let's be honest, money is that one factor that a lot of people, most of the people use to measure success, right?
Sure.
And I've seen that a lot of people my age, a lot of people in different paths and different backgrounds that come from a different background are all chasing this thing called money, right? But that is something that we don't really know a lot about. We are not taught about it. We don't have lessons on it, neither in school nor in colleges. So let's start with the fundamentals, right? Let's talk about what is money.
So, King, I think you put it out very nicely, and the bottom line here is that money allows you to do what you want to do. So, having the right amount of money is I think relevant for all of us. As far as finance itself, again, you can't wish away finance. Finance is almost an integral part of everything that we do today. Means you like it or not, it will be measured in finance. And if you have financial freedom, I think then the joy of being able to do what you love doing, it really transforms the way it's done, right? Because when you're driven by the underlying criteria of money or how much margins you have to make or things like that, then I think it takes away some of the fun in it, right? And if you get that number right, if you have a degree of financial security and in your head you know what you need and everything you need you have, then I think you know you're in the right place.
Because that is a $1 million question. how much is enough?
Okay, so we can obviously look at it numerically, or we can look at it, very vaguely in marketing terms, right? Because in marketing terms, it's never enough, right? No matter how much money you have, is enough. But numerically, you would be able to calculate backwards of what you spent today. And again, the first question you want to ask yourself is, are you in the place you want to be as far as expenses, the life you lead, the car you drive, the house you live in? If you have an upgrade on that you need as you think is the bare minimum, then you can do a maths of what that number is and what that number would need on a monthly basis. The broad thumb rule is, if you manage money in a decent manner, you can pull out anywhere between 3 to 5% of that per annum, and it will adjust for inflation for pretty much life, right? So again, I'm just giving you pure numbers here. If I want to pull out, let's say, 3 lakhs to 5 lakhs a year, I need to have a crore, right? Now, if that is 3 to 5 lakhs a month, you need to have about 10 to 12. So that's how the numbers will add up. And I think
Right.
then you know where you need to be.
Why I was so why inflation is such a personal topic to me is because I think all are running after this thing called money,
Right.
and somebody is uh, putting a hidden tax on it, right?
Right.
And we are not even realizing it. So let's say you rightly said that money is basically something that we can you use in the future for the things we like. So
Correct.
it's a way to store the value of our labor. We
Absolutely.
work so hard to earn this money, and at the back of it somebody's inflating it at 10%, 12%, let's say 4%, whatever the percent is. That means, so just give me a rough example of how long would your money take to get completely devalued. And let's say if the inflation is 10%,
Right.
right now you said the inflation is around 7%, but real inflation could be around 10%.
Correct.
So let's say if you have 100 rupees, in how many years your money will be worth nothing, let's say.
So, so again, King, that depends on the fact that what is your current money making, right?
Let's say if you're not making any money.
So if you're making zero, right? If you're just storing money, right? Uh, Again, if I can give you a sense, a basic meal or cup of coffee or whatever you want to call it, if you had it in Taj in 1990, it would have cost you 100 rupees. Okay, to have that same meal, I'm not talking about a coffee, it's a coffee with some snacks and all of that. Same meal for two people used to cost 100 rupees in 1991. Today, that will cost you 6,100 rupees. So if you have 6,100 rupees, that is equivalent to 1990 100 rupees, right? So how much time you have taken to lose that money is as obvious.
Right. So basically, what you're saying is by 10%, let's say approximately 10% per year, in 30 to 35 years, your money's value is almost nothing. That is that is so shocking to me, and it's heartbreaking actually.
Yes,
That's
side, where is
exactly
it?
where I think financial planning, what you rightly said, is very important, and the need to invest. If your money is getting devalued over a period of time, it's not that you should invest. It's like you need to invest. You need to be able to put your money to work so that, let's say, in 30 years, 40 years, it's not devaluing, it's increasing adjusted to the
What you're putting
inflation.
it aside for.
Right, exactly. I have studied a little bit of finance back in university, and I've gotten the understanding of inflation. But once I got into the understanding of what money is and why you need to invest and what actually inflation is, my like it was very shocking to me, the whole concept of inflation. So why don't you put some light on inflation? I really want you to tell people what is going on at the back end, because inflation is something you don't see on a daily basis. It's not something that you have to pay out as a tax money, right? But it is hidden. So let's
Right.
talk a little bit more about that.
So see, inflation, in any kind of investment. So when it comes to any kind of money, right? Money constantly faces two risks, right? One is inflation, and second is volatility. It's probably worth about a crore is worth about 6 crores today at 7-8%. The same person putting money into equity, a crore is probably worth 200 crores today, right? Now both of them are happy because the one is seeing 1 crore gone to six, others seen it to go to 200. But he doesn't understand the difference is 15% versus 6%, 7%. Whereas value of money has now probably what he needs if he had in 2000 or 1991, if he had a crore, the bare minimum he needs right now to adjust for inflation is maybe 40 crores.
So you mean the purchasing power of that money that he or she parked in
91
1990s wouldn't, let's say
would have
if he
lost
had,
75-80% of its value.
wow,
So what he could do then, he can't do today. So
with that amount of
with the
money.
same amount of money.
And why do you think that is? Why is there a constant inflation? This is not something that you find only in India. Why do we find inflation? Is it because of the money printing, or what is it?
So see, I think that would be a far more complex topic in the sense that the simplest way to put it is if you just look at your situation today, right? If you went back 20 years or let's go back 35, 40 years, FDs in SBI were 12% because inflation in India was 14, 15%. Today, inflation in India is 6-7%. Government 4.5 to 6%. What government says. Of course, real inflation could be a
That
little
depends
higher.
on what data they're presenting.
Exactly, but in Sri Lanka is still in excess of 15%. Right. At the same time, in the US, inflation is between 2 to 4%. So as an economy develops, I think things like inflation are better controlled. So many countries in Africa, they don't use their own currency; they only use the dollar because money printing could be one of the reasons, but inflation is by virtue of a lot of other anomalies that exist in the economy at that point of time. I think Sri Lanka, closer to home, we really know, is simply because it is a tourist driven economy. When you had COVID and multiple reasons after that, you had hyperinflation there. Right. So again, our other neighbor Pakistan, I think, has the same situation. Right. I think if you go back about 20 years, our currencies were almost at par, the exchange rate. Now it's very, very different. So I think so there could be multiple reasons why a specific country is going through hyperinflation or above average inflation or lower inflation.
I come from a traditional Banya family, right? And my grandfather sacrificed a lot of his health and his time with family for money, right? And I see a lot of families, a lot of people doing that. They put money over their health, put money over family, right? And I know where they're coming from. It's not that they're stupid. They have seen hardships in their life. That's why they want to get that kind of success, get that kind of money so that they can provide for the people that they love. But where do you draw that line? Where do you have that trade-off between money and, health?
So King, again, it's almost like it's almost a deja vu kind of conversation for me because it's a very similar conversation had today morning, and it kind of gave me an opportunity to introspect, right? Because like you said, the last generation, very often in India, we probably are among the first generations which have seen serious money because the generation either earlier or the one before that has worked very, very hard to put down and build what it has built, right? And the natural instinct for uh, for somebody who was even reasonably well heeled, um, maybe fuck you money kind of well heeled, might actually have their kids or the next generation go through certain hardships. Like a simple thing is maybe they can afford to buy a corporate jet, but they forget the corporate jet. They won't even use a first class ticket or a business class ticket. They'll
Correct.
say, no, go economy. Why do you want to
I'll
spend that
rather
kind of
shop
money?
for that kind of money when I'm
Correct.
going.
So that's the way maybe you would think, but they think that just save this money. They're not thinking of the shopping after, right? To be fair to them. Now, the interesting thing is they in their 60s will say, but I am traveling economy. So why are you not traveling economy? But in the same situation, they'll travel 24 hours in a direct flight and they would have a slip disc by the time they get there. right? And they'll probably spend 5x the money in treatment, right?
So you'd put leisure over money.
So I wouldn't put leisure over money, but I think for the next generation, especially when the parents have made the money, it's important to know the advantages that money brings, but you should also give them the required exposure so that they at least have a sense of the value systems that are in place, right? So it's like this when you, and again I was told this, I was informed, we had this discussion in the morning, like I said. He said, see, if I have fuck you money, but I treat everybody around me like shit, right? There's no point to that, right? So that means that's the value system, right? If you treat everyone around you nicely, I think that's a different value system, in spite of you having. So it's important to not have an ego. It's important to be open to learning. It's important to be able to listen, adapt, change. All of these things I think are as important as making most of the money that you have or not. And there is again no sense in having all the money in the world and leaving it to the next generation, which might anyhow blow it up, right? So see, risk adjusted return is a relative term, right? Because what is uh, what is risk, what is the real return of things, right? The real return of something is your return that you're making minus inflation, right? So let's assume for a second inflation is 10%. Today, the safest instrument that we can put money into and most liquid is Government of India bonds, which you can, that's debt, right? And that will make us 6%. So if I want to be exceptionally safe, right, the thing I can do is put money into government bonds. I will make 6%. If I am in a reasonable asset allocator, then I have tax at 35%, which means another 2% is taken out by the government of India from the 6%. I'm left with 4, and I have 10% as inflation. So net, I'm losing 6% per annum. So if I just want to do the maths, today if I have 100 rupees, next year I'm starting with 94. Right? So that is the basic maths on inflation and risk adjusted.
And like just for the viewers, by bonds we mean FD. FD is sort
Yeah, FD equivalent. So Government of India issues 10-year bonds, 20-year, 30-year bonds. You can also buy shorter term bonds, but of course I'm assuming this is somebody who's planning retirement.
so debt is sort of the investment which is safe. What about the time period?
So okay, so in asset classes, I would say debt is meant for money which is 3 to 5 years, which could be parked in debt on the higher side. Equity is, I would say, 4 to 7 years. Even 7 to 10 years is what I would say. Equity is
And
the
risk appetite
timelines.
for equity.
I'm sorry.
Risk appetite for equity.
So at any point of time when you start, you should be okay with losing 40 to 50% in the next 6 month period. So it's something that can happen. And again, it depends on what concentration and what diversification you followed. But if somebody wants to look at equity for more than 7 years, the probability that he'll lose capital is very, very small, less than 1%, right? Most likely, he should end up with excess of 12% returns. 12 to 15% is what he should generally end up with. But in the near term, he can lose 20%, 30% in
So
2 months.
your time horizon for the investment has to be longer for it to average out to around 10 to 12% per
Absolutely.
annum. That you're talking about index funds. Is that something you'd recommend to most of the investors?
So I feel, see, if you don't understand anything, then that's probably a better way to do it. Having said that, I think in India, active managed funds still, there is a serious degree of outperformance versus index funds. And I think that has some more time to go. That play is still on. Till India becomes a more, I would say, mature market like the US, where I think the differential is much lower.
Yeah, because I think I read somewhere, I don't know if it's only about the US or general markets in perspective, but almost 70-80% of the money managers in the longer period of time do not tend to outperform the index fund. Is that
So that's the case for the US,
that's the case for the
right?
US?
But in India, that's almost inverse.
Okay.
So over a long period, most money managers, active fund managers, almost
Are
70,
making more
eighty
money.
percent beat the index,
Okay.
right? And then there are other nuances of the index which keeps changing, and all of those, that is again not factored in. There's a tracking error that happens. So all of those things also. So I historically, at least from the last 10, 13 years that I have been in this space, I have seen active managed funds, most of the flagship fund houses, flagship schemes, deliver anywhere between 2 to 3% outperformance on the index per annum. And that really adds up to quite a bit
That's
over,
quite good actually. So for a normal person who's not, let's say, who doesn't understand how to read the balance sheets, who doesn't understand how to understand the management, the industry perspectives and all that, you'd still say index is a safer.
Definitely. I think being in an index fund or in one of the flagship mutual fund schemes is probably the better way to go. It doesn't have to complicate life. And again, when it comes to anything investing, right? Let it be real estate, let it be equity, let it be debt. If you don't understand it, at least to some extent, then you should probably get some expertise or some expert help in that.
So we've covered debt, we've covered equity. Um, the third one you spoke about was gold or commodities. You want to tell us a little bit about that as well?
So see, gold, like I said, in cosmic timelines, does adjust for inflation, right? Again, timelines you have to talk about are in excess of 30, 35 years for gold. If you see the peaks that gold has had, gold peaked in 1980, that was 45 years ago. Then it had another peak 2006 during the financial, just before the financial crisis, when the equity markets were peaking, gold also peaked. And then again it had a fall during COVID in India and Europe. We had seen again a spike in gold. Again, you couldn't really liquidate gold, physical gold, at least at that time during COVID, because everything was locked down. I had no clients of mine who are jewelers, and they were not buying gold because nobody was buying it from them. So there was no need for gold at that time. And then you saw it very recently with Donald Trump and all the global trade wars. You've seen a degree of spike in gold, and I think that's also more not for the reason for gold itself, but the fact that Mr. Trump was looking at weaponizing the dollar, and when you can't apply too much thought as to what is an alternative to the dollar as a reserve, you want to figure out something, and that's gold. So
It's safe to say that gold outperforms when there is turmoil in the market.
I think it depends on the type of turmoil, because I don't think gold outperformed because of the Gaza, Israel, Palestine conflict or Ukraine, Russia conflict. I think the reason for the spike itself was the fact that there were sanctions on Russia. Then suddenly China looks at gold not being dollar not being an alternative, so let's hold it things in gold. So I think it's more like an alternative, which is caused the spike. So yeah, I think that's the problem with gold. Having said that, I think historically and mathematically speaking, if you have 5 to 10% of your balance sheet in gold, there is a degree of hedge that it has provided, right? So I think you can't take that away from it. Gold doesn't multiply. Again, it is finite, the amount of gold that's mined. So it's a physical asset, of course, but it has the inherent
It's
advantages.
perks to it. Now, my favorite, real estate. What do you have to say about that? And also, I have noticed, especially like I come from a place called Neemach, it's a tier 2 city, and majority families in, let's say, in that area have more than 80, maybe 90% of their net worth in real estate. So what is your view on real estate? How much real estate is too much real estate? Because there's always an angle of liquidity, indivisibility towards real estate, which are some of the challenges to it. But it has it through time it has worked out very well for people. So what are your thoughts on that?
So see, again, the reason real estate historically has adjusted for inflation is the fact that you were using land to grow something, right? Which is crop, and the crop adjusts for inflation. That's what goes up in value. So the land goes up in value. So there is a direct correlation there. What's happened in the last 2 decades in India is there has been a high degree of urbanization. So you can see villages getting smaller and cities getting larger. So there has been a huge wealth creation for those farmers in Gurgaon, in Noida, who had sugarcane or cotton growing on the land, and suddenly they have high rises there, right? DLF projects are coming there, so you have this huge wealth creation. But if you take it purely on merit, I think real estate has a 25-30 year cycle, and if you're okay to stick to that cycle, then it's good as an investment. I think 30% of your balance sheet in real estate has always again worked very well for most people. Again, this does not include the house you live in, because that's priceless. And again, there are broad thumb rules which say that prices are expensive or cheap. So they typically say that if you want to buy property to live in, it should not be worth more than 5 times your annual income. Right, 5 to 6 times is an ideal number. 10 to 11 is a little bit on the higher side number. But we had situations 10 years ago where real estate residential property was 25-30 times your annual income, right? So you're just assuming that property would continue to grow at that rate, and maybe the salary. So that's the only way you could justify it, and you had that situation. And today that is turned negative. Absolutely. And I think you mentioned that you have situations today where 90% is in real estate of your wallet share or your balance sheet. Now, that's again because human tendency is to keep adding that which is working without an asset class clearly being defined. So if you started investing in real estate somewhere in the 80s, 90s, 2000s, you continued to invest in it, and that grew. So that became a lopsided part of your balance sheet, and every saving that you had went back into that. Now, especially in Bombay, in cities like Bombay, you can see a situation where the last 10 years people have not seen money in real estate. And that's probably the reason you can see this money getting channeled into the equity markets and a lot of the other asset classes which have recently worked. So again, you're mentally, okay, last 5 years, what has done well? Equity has done well. So let's pile into equity. Then let's get out of real estate. So today, everybody who has the fourth, fifth, sixth home, which he was renting out, see, rental yields are 1.5%, right? So everybody who has these third, fourth, fifth home is saying that, okay, let me sell out 2 properties and put that into equity. But it's not being done in a disciplined manner. That's why you get lopsided, and then you try to course correct. If you have time to retirement or time where your cash flows continue, you will get that opportunity to recorrect. But if you are at that point, if you're an employee or you're a salaried person at 58 or 60, and you have 99% of your portfolio or balance sheet in real estate, then you're in trouble.
Let's build portfolios for, let's say, a 30-year-old and a 60-year-old, right? For a 30-year-old, what is the division like in terms of portfolio percentages, like for a.
I'm assuming he's building his balance sheet. For that kind of an individual and he has time on his side, I would say it should be equity heavy, financial asset heavy, and equity heavy. What I would say on the higher side is maybe 9 months of expenses in debt, which doesn't have any return value to it. It's just a safety value that in case he loses his job, he has an accident, it covers
And
him
that
for
means bank account mein
bank
paisa
account
rakha
or FDs or bonds, government bonds, whatever that whatever he feels. There are also hybrid debt
hai.
equity
Debt
instruments
funds
which you
also
will
there.
not lose capital in. Worst case scenario, best case scenario, you make your 7-8%, and which are tax efficient. So that's probably for a 30-year-old. For a 60-year-old, it's not that easy because it depends on what corpus he has already built, right? Because a 60-year-old who has 50 crores of net balance sheet can have a very different allocation versus a 60-year-old who has 5 crores will need to have a very different balance sheet or different balance, right? If he has the house he has lived in, he owns the house he lives in, he doesn't have any outstanding loans, then I would say he would need at least 50% in equity,
Okay.
ideally 25%, which is 2.5 crores in real estate, maybe rental income or something on those from that, and maybe 2.5 crores from debt. But the problem here again is in a city like Bombay, 2.5 will not take you too far when it comes to a property. So it could be one single property. And if he gets into a problem with a tenant where he's not emptying or you're not moving out or something on those lines, that can really, stress
The
the cash
management
flows.
of the property.
Yeah.
So for a 60-year-old, you'd say 50% in, 25% in real estate, 25% in equity, in debt, and 50% in equity.
Equity. So I would put it this way: for a 60-year-old, I would say anywhere between 3 years to 5 years of money should be in debt. because any money in debt more than that 3 to 5 years is going to lose the value of it by the time he gets to that 5 years. Right? So that is unfortunately forced to be in equity, because five is unfortunately a very, it's not an ideal situation to be in, right? Because if he's in 8 or 10 crores, then it'd be very, very different. So, so it would be very, very selective, customizable based on where he stands.
And for the 30-year-old, let's say 9 months in debt, what about, like, let's say, what percentage is equity, what percentage is real estate?
So again, for a 30-year-old, I'm assuming he's just building his balance sheet, so he can't pick real estate. So the only alternatives you have to real estate in that sense today is REITs, but there is no alternative. So it's Tina. So if there is no other alternative, you have to probably pick 15, 20, 25, 30% real estate. Is this the best way of doing it? I don't know. Right? Again, if you're at 10 crores, one property will take out 5 crores. So is that the best way? Also, I don't know. So I think India is really starved currently for a good real estate alternative. So as a financial advisor, if I get something that can give a person, a 25, 30% allocation to real estate while having a degree of liquidity and capital appreciation, I think that would be very, very welcome. I'm talking about it if I, as an Indian, want to have a 25% allocation of my balance sheet to real estate. Not that I'll stay in, not that I'm going to invest in, but just as a, to get the participation of how real estate will do. For those, there are not too many defined vehicles which I can participate through. The only vehicle is REITs, and that, like I said, it's only 4, 5, 6 of them, and some of them are also not very
Because
clear.
of the ticket size.
Yeah, the rest are. I have a limitation of ticket size, so that is something that kind of keeps most people out of it.
Brilliant.
Thanks a lot.
What is your viewpoint on land as an investment? Because real estate is also divided between apartments and lands. Since land is something that is, you cannot print land, like it's finite, irrespective of like how much you make money, how much the people make money, you can't really build a lot of land. What is your viewpoint on the investment?
So see, number one, this theory is there that we can't print more land, right? That's absolutely right. But the other thing about land is you need to occupy it and you need to produce from it, right? It's good to say that where you're standing, from there to the next mountain belongs to you, and but if it's forest and you have never been able to access it and neither is anybody else going to access it, then it won't matter, right? So land, yes, is important. Location of that land is probably even more important. So I think from where you come from, it's a tier 2 city, but it's still one of those growing states where the population continues to grow. The average age is in your favor, where at least for the next maybe 2 decades, you will see the population continuing to grow. They will go out, they will probably earn money, come back and want to buy one of those plotted plots and build a house of their dream there, right, once they retire. But I think what we don't account for, and again, you can go back to some of the other states that we have in India, where people used to go abroad, they used to earn money there, and they used to come back and settle for retirement. What's happened today? You're going abroad, but now all of these countries they went to are giving you citizenships. So they are buying the house there. They're settling there. They're not coming back and trying to build a house here.
I think
And
there's something about the safety and about the financial discipline of buying a property that
I think that's something that has been taught to us, no? I think that's ingrained in our psyche that if you're saving, you need to have your first property. Means the same happened with me. Means my parents almost insisted that I need to have an investment property, which I bought a land on the highway some time back, and means I can just tell you I bought this in 2012, probably at the worst time I could, but something that I bought for roughly a crore today would best case be a crore and a half, right? I know what I have liquidated to buy that plot of land would be today worth 6 crores, right? So one way of looking at it is I've lost opportunity cost of 4.5 crores. But like I said, it's not the way you should look at it, because different asset classes will perform at different times. And if I had nothing in anything else, then I would be in a far worse position than I am today. This is something might
Asset
become
diversification is the key, I think.
absolutely. And then, of course, some of them might work for you, some of them might not. But as long as when you buy, there is a broad logic around it and broad numbers are done around it, I think it's
And at
okay.
some point, it might perform.
Perform. Exactly. Exactly.
So, George, we've briefly spoken about the main asset classes, the traditional asset classes per se, which would be real estate, equity, debt, and commodities like gold. Now, there's another asset class that has emerged in the past few years. It has been, so Bitcoin and digital assets is another asset class that I have been very interested in the past few years. And I wanted to know what your opinion is on such asset classes. You're speaking to the top 1% of India, right? And I want to know, are they talking about Bitcoin? Is it something that they're considering? What are the conversations like in terms of their acceptance towards Bitcoin? Because in the past few years, we've seen a lot of changes in the digital asset space. We've seen Bitcoin climbing from all the way from $25,000 to almost $120,000. We've seen big giants like BlackRock, Fidelity in the business with their ETFs. Apparently, the Bitcoin ETF has done better than any ETFs till now. And yeah, there's a lot of regulatory clarity also from the Trump administration around this industry. So, given these factors, what is it like speaking to clients about digital assets in India?
So, I thinking, you know, Bitcoin, or I think digital currencies cryptocurrencies in general, or even digital asset classes in general, are definitely the new kids on the block, right? And everybody talks about Bitcoin because it has its claim to fame. It's been one of the best performing investments, if somebody has looked at it that way, from 2008-9, from the time it's come into reckoning to where it is today. You've already told me, I think in 2014-15, if I'm not mistaken, it was still at around $7,000-8,000, and now of course we are closer to in 2017-18 it was $25,000-30,000. Today we are closer to 1,10,000, 1,20,000. Of course, it moves by $10,000 on a given day. So it's worked, right? I think the U.S. And Mr. Trump in particular. So again, this is how politics plays a role in this, because till Mr. Donald Trump didn't come on board, I think the Fed and the SEC and most of the US regulators were proactively trying to stifle off cryptos, and were not.
They were not for it, for
not
sure.
for it, for sure. There were accounts that were getting blocked. There were KYC requirements that came up. In India also, we had enough turmoil, and I think the last budget or the budget before last, the finance minister at least figured out the taxation that is applicable, some clarity on the taxation. So it's still practically a new kid on the block. Of course, value-wise, I think Bitcoin today is, I think, the 5th or 6th largest asset class, right, that exists. So there's no wishing that away, right? As an advisor, it's not something I have very proactively followed, simply because I've done Bitcoins for a few clients, and we've ended up making phenomenal money. But my argument for or against has always been that when I made money, I need to know why or how I made money. And when I lose money, I need to know why or how I lost money. I think Bitcoin, unfortunately, it has not answered those questions for me, in spite of the fact that I made money, right? Also understand that the clients, at least that I manage, the top 1% of the population, like you said, of the country, would typically be, upward mobile, of course, but also at the age group of, I would say, 50s, 45, 50, 55 plus, bare minimum. And for them, what is the amount of money you're ready to let go? Because I have clients who are in the US today, and they'll tell me about how they've done some Bitcoin. But almost everybody with that statement also tell me, oh, this is the money I'm okay to let go of, right? So if it's not going to be a serious allocation, right? If it is something you want to try, then I don't know how to apply that in a larger balance sheet environment, right? You want to lose 5% and you're okay with it. Okay, the 5 can become 100% of your balance sheet. Great. But as long as the discipline is not because you made 5 and put the remaining 95 also into it, but because 5 grew so much that the remaining 95 has become small in proportion.
So let's put it this way. In order to understand Bitcoin, I'd say it's very similar to the principles of gold, right? So why is gold valuable? Because it's limited in supply. It takes a lot of capital and energy to make more of it. There's a inflation of around 2%. Like there's 2% more supply of gold coming in every year, right? So similarly, there can only ever be only 21 million Bitcoin, right? So it's a limited supply. First thing we know that it's like gold because it is hard money. Just the way we spoke about inflation, we need something that is not devaluing in nature. When you have Bitcoin, it is not devaluing in nature. It is scarce, it is hard. That's why it works as a digital gold. Now let's talk about why it is better than gold in my opinion. Gold is indivisible to a large extent and not portable. So let's take a hypothetical situation, right? We we had this scenario in like when we got independence that we had a partition. Right? Imagine you were in Pakistan or something and you had to move to India, and it wasn't safe for you to get any gold cross border because you would have been robbed or killed or something like that. Similarly, you wouldn't be able to move your real assets. Your bank accounts might be frozen. What is something that you can hedge, that you can use as a hedge for times of turmoil? So that is another thing that you can walk across borders. You can go from A to B with, let's say, your seed phrase or the passwords in mind or in paper or whatever form you want to put it, and you can cross borders with value. That is another thing. And also, if you were to transport or send, let's say, $1 million या 7-8 crore का gold आपको A to B भेजना है, that will come with a lot of costs. But when it comes to Bitcoin, you can exchange that value in a few seconds at a fraction of the cost.
It just gives me too many moving parts. And again, Bitcoin as a specific crypto might be something that somebody could look at. But it's like saying that, lottery tickets historically have got people who have made serious money, right? But how can I make a strategy around it? I'm not sure, right? There is no denying the fact that people have made money in lottery tickets. But like I said at the very beginning, if I'm not clear how to make that money or how to lose that money, then I don't know if that is a space I want to be in, number one. Number two, again, maths says this, and that the higher the risk you take, right, the higher the returns you will make. But with every degree of risk you add, and this is risk-adjusted return, coming back to that, once you keep adding a point of risk, the potential returns go up. But you will also see the probability of that return going down, right? So how much do you want to increase your risk to? Because what has historically been shown mathematically is that a probability of 12 to 15% you can do with a 70-75% probability of outcome. Once you get down to 50 and beyond, of course you will make far more money if it works. That's exactly the probability of a lottery ticket. It's 1 in a million. Right? So if you manage to win the lottery ticket, you had 1 in a million chance of winning. You got that probability and you paid maybe 100 rupees or 1,000 rupees for the ticket and you ended up 100 crores. Right. But that's 1 in a million chance. So I don't want to actively operate in asset classes where I am not very sure about the probability, or I can't mathematically figure out the probability. I'm not saying Bitcoin doesn't have it. I'm just
No, you're talking about other cryptocurrencies because that's a very fair point. There are around 19,000 other cryptocurrencies other than Bitcoin, and uh, majority will go to zero. Almost 95, 99% of them will go to zero. It's like what happened in the dot-com bubble era. Everything like pets.com and shoe.com and soap.com, everything had a .com in it, right? But there were some Amazons, there were some Googles.
say that. So, and Amazon did come back, right? So, where there is value, and if it is able to create that value proposition for itself, then I'm sure there is going to be an allocation that comes its way. And like I said, US, Dubai, some of these countries have given that this thing with the no fallback option kind of thought process. See, in India, we are not in that space.
It's quite premature right now, and I'm not sure if the government will be happy with people doing that either.
Just think about it, right? You're basically what a Bitcoin says is not, yeah, I know you said decentralized, but what it actually does is centralize the world into one marketplace, which is an ideal situation.
Right.
Then no country has a decision on anything.
Right.
There is no single, if you just use Bitcoin as a currency, then
Right.
the dollar doesn't, so it solves all your problems.
Exactly.
Actually.
Like you just like mentioned the Russia war that happened with Ukraine. Um, the dollars were seized, if I'm not wrong. They were
Correct.
sanctioned, right?
Correct.
Imagine having so much money in dollars and that getting sanctioned, so you can't spend it anymore in the time of war, right? So I think even countries like BRICS and Russia are thinking about alternatives of dollar now. So
Correct. So that's the reason gold worked, and
Right.
that's probably the reason Bitcoin has
Bitcoin
worked.
might
right?
work, yeah.
And like you said, cross country, cross border, you can move money from here to there, and
Instantaneously,
vice
yeah.
versa. If you have, so there is no denying the fact that it is solving blockchain. I think has been adopted by many other entities
right,
to be a phenomenal ledger
there's
system.
tokenization of real world
Tokenization,
assets and
correct.
stuff like that. As well.
Correct. But at the same time, that's also had its negatives, right? You have had enough situations where you own part of a painting or part of this thing,
and
and
that
digital
becomes
tokenization,
worthless,
and it's
yes.
worthless, right? So it's going through that learning curve. Means my job, like I said, is to be 70% plus probability of delivering what I can deliver. My job is not to try and hit that 2% probability.
Gets me to another interesting question. Which currency do you think AI will use? Let's say right now we're using AI for different activities, language processing and all that. But let's say when AI starts transacting with another AI, which currency would they use? Would they use Indian rupees? Because let's say if government comes in tomorrow and says, okay, we are printing 2 trillion Indian rupees. So now the currency that the AI is using is devalued, let's say. Or the same can happen with US dollars. Or would the AI use something which is set in stone in code, which is like Bitcoin?
So I think, I think we are really getting ahead of what I understand as far as today.
It's just
a
wild
very-
guesses, right?
It's a very, I would say very, very logical query.
Right.
Means to tell you that I have an answer to it. No, I don't.
Right.
Right.
Take a wild guess.
So I think something like Bitcoin would be an ideal situation, right? Because I don't think something else that encompasses cross borders. It is not impacted by this thing. Will AI bring about, or all AIs come together, discuss
And bring their own
and
currency?
I think
That could
that
also
could be a larger probability if we reach that situation.
We've had a very interesting conversation. We spoke about money. We spoke about different asset classes. Spoke about Bitcoin, AI. I love the conversation. Right now, let's shift gears a little. Right, it's time for hard hat or hot take.
Okay.
So how it goes is, I'll put forth a few opinions or statements, and you have to choose if it's a hard hat or a hot take. Hard hat meaning you agree with it, it's a comfortable agreement, and hot take is a little controversial,
Understood.
sort of a spilling the tea. Right, so You can sip your tea if you would
Absolutely.
like.
Shoot.
Yeah. So, buying your first flat is a personal milestone, not a financial strategy.
Hard hat.
Most people treat their wealth managers like family doctors they call only in crisis.
Hard hat.
Builders oversell lifestyle, finance guys oversell peace of mind.
Hot take.
The real reason people invest is so they can flex on WhatsApp groups.
Hard hat.
Brokers are underrated psychologists.
Hard hat.
Crypto is confidence without consequences.
Hot take.
In most families, Excel sheets are more guarded than property papers.
Hot take.
With that, George, thank you so much for
It was a
being on the
pleasure, King.
podcast.
Thank you for having
It
me.
was an amazing conversation, and thank you for being here again. That's a wrap on this masterclass in money with George, a man who reminds us that true wealth isn't built overnight, but with clarity, conviction, and the courage to not follow the herd. From soil tests to spreadsheets, from legacy to liquidity. If you're looking to build something that lasts, this is the blueprint you come back to. If there is anything from this conversation I want you to take, is that work hard, but be smart about money. Until next time, keep building, but don't forget to think beyond the bricks.